Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. In today's episode, I want to tell you about an incredible leader that you've probably never heard of. This guy grew his stock price by 30% compounded annually over 25 years. That's an insane rate of return. It's higher than Warren Buffett's rate of return. Warren Buffett compounded at about 20%, and he's considered to be the best investor of all time. So who is this guy that beat Warren's track record? His name is John Malone, and here's his story. So he's born in the US in the 1940s. He's a studious type, so he ends up getting 2 master's degrees, because 1 master's degree is not enough, right? So get this, he then goes and gets a PhD as well. And they're all from reputable schools, by the way. On top of his great academic track record, he also has great people skills. Out of the gate, he's an unusual person. He eventually goes to work for McKinsey. If you haven't heard of McKinsey, they're top management consultants, and it's really prestigious to work there. McKinsey is also known for insane working hours. I had a chance to chat with one of their associates, and it's common to work 70-hour work weeks or more during their busy season, so it's not really a 9-to-5 type of place. So John's working at McKinsey, and that gives him insight into the inner functioning of the cable business. He learns that the cable industry is growing super quickly. There's a 20x increase in subscribers in just a handful of years, so business is booming. If you can pick any industry to be a part of, you definitely want to pick the one that's growing quickly, because growth allows for more money to spread around, and you also have more opportunities. He gets an offer to become the CEO of TCI. TCI is a cable company that's almost bankrupt. The company is in big trouble because they have $12 million in sales per year, but they owe creditors over $130 million. At this point, John has been a student of the cable industry, so he feels that this can be a good asymmetric opportunity. In last week's episode, we discussed these asymmetric opportunities where there's a huge upside and a small downside. This is exactly what John is seeing. He might be able to turn the company around, and if he does, he's going to get super rich. If it doesn't work, he could always get a job somewhere else, especially with a McKinsey reference on his resume. So this looks like a really good risk to take, even though TCI might go bankrupt. Apart from this asymmetric opportunity to get super rich, John likes the cable industry for a few other reasons. These are some nitty-gritty details, but I want to go over them to give you an idea of what John liked about the business. The subscriber bases are pretty stable, which means that he can predict revenues and make accurate forecasts for strategic plans. This is important because it's going to allow him to use debt as part of his growth strategy. The cable business also structurally allows for some tax maneuvers to reduce paying taxes. This is completely legal, by the way. There's no funny business going on here. The way it works is if he's running a cable company, he can borrow money to build new cable systems. The interest on the loan is tax deductible, so it reduces the taxes that he pays. Also, these new systems that he builds are depreciable assets, so the depreciation on them also reduces the taxes that he has to pay. So he can keep growing the user base and reinvest into the company and avoid paying lots of taxes. Sorry to get too technical, but that's just some background on the nature of the cable business. So after joining TCI, his first goal is to keep the company out of bankruptcy. That's priority number 1, and it takes a lot of work to do that. He starts this lean culture where he cuts costs. He only keeps a single receptionist at headquarters and makes multiple executives stay in the same motel room when they're traveling. You can imagine that the executives are not too thrilled with this, but the company is on the verge of being bankrupt, so it's John's way or the highway. Amazingly, over his first 4 years, John gets TCI to have the highest margins in the cable industry, and he increases subscribers in a huge way. He really improves the cash flows in the business. After the company stabilizes, he focuses on this big growth plan that he has. John realized that there's big economies of scale in the cable business. This is mainly because cable companies have to pay content providers like HBO and MTV for the right to show their TV programming. This content expense is one of the biggest expenses for cable companies. The kicker is that large cable companies can negotiate lower fees per subscriber, and this allows for scale. John realizes that the key is to grow the number of his subscribers, which would allow him to pay less content fees, and this would allow him to keep more cash to make acquisitions and keep growing the business. It's a big growth cycle. Let's break it down a bit. Here's how he does it. He buys cable companies to get subscribers. This leads to lower fees that he pays for content. Lower fees mean that his cash flows increase. The higher cash flows allow him to take on more debt and buy more cable companies. This reduces the fees he pays for content because the more subscribers he has, the less he ends up paying per subscriber, and that allows him to buy even more cable companies and to repeat this cycle. So John goes on this tear where he buys over 480 companies in a span of 15 years. So he's buying a new company every 2 weeks essentially. As he's doing this, he's still being choosy about valuations. Sometimes you hear about CEOs that want to feel important, so they make crazy acquisitions and overpay for them. John is being very calculating about his acquisitions. His goal is not to have a huge empire of businesses. His goal is to make money for his shareholders. Since he's a huge shareholder, that'll make him very rich as well. He's avoiding buying companies in urban markets because those have a ton of bidders, which causes them to be overvalued. Instead, he's focusing on the rural markets where he can get a great deal. It's just like if you're buying a house. It's going to be a lot more expensive if you buy it in Manhattan, but cheaper if you're out in Yonkers. No disrespect to Yonkers, by the way. I just Googled it and it looks like a really nice, quiet place to live. This strategy of buying cable companies in rural places works very well because eventually some of those urban cable company acquisitions that John avoids end up in financial trouble because there's too much debt used to buy them. So a number of years later, John swoops in and buys the assets at amazing prices. So as he's making all these acquisitions, John has such an in-depth knowledge of the industry that he's able to figure out exactly the right price to pay for each company that he buys. And that's a huge strength of his. He's laser focused on this niche, so he has a huge depth of knowledge that he's using to his advantage. By the way, he's also known as being a super tough negotiator. Al Gore famously nicknamed him Darth Vader. And it makes sense. The guy negotiated hundreds of deals in his life, and he knows the cable industry probably better than anyone else out there, so he's an absolute savage when it comes to negotiations. The other thing he does well is cost cutting in companies that he buys. One example is when he buys this little cable franchise, and right away TCI cuts their payroll in half and moves their office from a downtown skyscraper to a tire warehouse. So if you're an employee and your cable company is bloated with expenses and it's up for sale, you're hoping that John would not buy it because there would be some big changes coming if he did. One thing that John doesn't invest in is in improving the cable infrastructure. He doesn't see a clear return on investment for upgrading to new technology. Instead, he likes to wait until his competitors scramble and figure out what works and what doesn't. Then he learns from their mistakes and follows the winning path. Throughout his TCI career, he never really cares about showing positive earnings that much. His focus is on making money for shareholders, and he owns a ton of shares, so his interests are really aligned with the shareholders. This means investing company money into projects where he gets the highest returns. It really reminds me of the way Amazon handled their capital allocation. Jeff Bezos kept on reinvesting capital to different projects instead of flowing money out of Amazon. So Amazon doesn't look to be a really profitable company, but that's because they reinvested lots of money into new projects internally. John's impressive run continues until TCI gets sold to AT&T in 1999. It's a huge deal that awarded John Malone something like $15 billion in stock, which is fair considering he masterminded a lot of the TCI growth. So that's John Malone's TCI story in a nutshell. After all was said and done, he compounded his stock at a rate of over 30% per year. So if you invested $10,000 with John when he started at TCI and kept your money with him the whole time, you'd end up with around $9 million by the time the AT&T sale happened. That's an insane track record. If you look at Warren Buffett's rate of return from when he bought Berkshire Hathaway, Warren Buffett's return is around 20% per year. So although it's kind of like an apples to oranges comparison, it's still interesting to note that John Malone compounded at over 30% per year over 25 years. By comparison, if you invested in Google or Facebook when they first went public, and you held the stock until today, your annualized return per year would be around 24 or 25%. So John Malone is an absolute machine for compounding at 30% for 25 years. So now I want to go over the top 3 lessons that we can take from John's story. The first lesson is that it's good to be part of a booming industry. John started working in the cable industry at a time when it was going through huge growth. He had big tailwinds helping him produce amazing stock returns. As an example, today one of the big themes is green energy. If John Malone had to work exclusively as the CEO of a coal company in today's environment, I doubt he'd be able to match his performance from the TCI days. It's good to be part of an industry that is growing. The second lesson is on how important it is to have a circle of competence. Warren Buffett and Charlie Munger talk about this a lot. The circle of competence is pretty much your area of expertise. It's what you're really good at. John understood the cable business extremely well, and he stayed there to a large part. Later in his career, he bought some content providers, but those were also in related businesses that he understood really well. During this amazing run at TCI, he focused within a clearly defined circle of competence. It really just comes down to this. It's easier to be world-class at one thing, and if you're going to be great at buying companies, your chances of being really, really good at that increase if you're always buying the same type of company. John was an expert in cable, so he stuck to his expertise and made a killing. Do I think his returns would have been as good if he went out and started buying up oil refineries in the middle of his TCI career? Probably not, because that's not where he had his expertise. Sticking to this circle of competence allowed him to be an amazing negotiator as well. He knew the right price to pay for companies, and he didn't try to go into other areas where someone else knew the business better than him. This doesn't only apply to big-name CEOs, by the way. You can apply this to your own life, and I'm speaking from experience. Once upon a time, I was a personal trainer, and at the same time as I was training clients, my partner and I started a business in making promotional products for companies. Our business sold shirts, sweaters, pens, bottles, etc. with a customized company's logo on them. The business did okay, but it was so far outside of my circle of competence that it took a lot of time to learn. It would have been a lot easier for me to start a business in the personal training or fitness space. I mean, I was already working in that space, so I had the expertise. So as we can learn from John Malone, it's good to know your circle of competence and stick to it. If you're investing in someone, it's good to know what their circle of competence is. And if they deviate from their circle of competence, it might be something to look into. My last takeaway is the importance of capital allocation for continued stock growth. By the way, capital allocation is just a fancy way of saying where you invest money. John invested in projects that generated amazing returns. He understood that the cash generated from companies that he bought was more than enough to cover the interest payments on the loans he took to make the acquisitions. He was selective in how much he'd pay for a company, and he was super careful not to overpay. This is hard for CEOs to do because ego can get in the way. There's a term called the winner's curse, where a CEO's ego spurs them on to spend whatever amount in order to be the winner in the bidding for buying a business. A lot of times that leads to poor investments. If you're a CEO of a company and you pay $110 for something that's only worth $100, that's probably not going to work out well long term. Another thing he did well in capital allocation is that he didn't upgrade cable systems just for the sake of upgrading the technology. He waited until his competitors tried different ways and failed, and eventually, once they figured out what worked, he would go in and implement the method that worked instead of having to fail a bunch to figure it out. That saved TCI a ton of money. It's not always good to be first. Sometimes it's better to let the other person go first, fail a bunch, and once they realize what works, you can follow the proven path. Thank you so much for listening, and I hope you have an awesome day.